Hello students, welcome to Accounting Explained at Accountwise Academy. This is Latha Venkateshwaran. This is the fourth video on payback period. Today we are going to see discounted payback period. Before proceeding to discounted payback period method, I am going to give a short description about payback period. Payback period is a time taken to recover initial investment through project cash flows. Cash flows here means cash inflows. Okay, if the initial investment is rupees 1 lakh, the time taken for it to recover this initial investment through the project cash inflows is called the payback period. Suppose if the project cash inflow for the first year it is 25,000, for the second year it is 40,000, for the third year it is 20,000, and for the fourth year it is 15,000. The total of it is 1 lakh. So it takes 4 years. Time taken is 4 years to recover the initial investment through project cash flows. So this 4 years is called the payback period. Okay, it is a simple and popular method for evaluating investment proposals. See, it's very simple. Just add all the cash inflows, then you will get the time taken to recover the initial investment. Payback period ignores the time value of money. This is very important. It ignores the time value of money and focuses on cash recovery speed only. See, it focuses only on the cash recovery speed, but it does not give weightage to the time value of money. We are going to proceed to the discounted payback method. The discounted payback period method is a modification of the traditional payback period method. Calculation, formula, everything is same, but there is little modification or little tweak for calculating the discounted payback period. It addresses the limitation of the traditional method by considering the time value of money. The modification here is it considers time value of money. Time value of money chapter is very exhaustive. It has future value, present value of single cash flow, future value and present value of multiple cash flows, present value of annuity, future value of annuity, etc. All these videos I have uploaded in my channel. I will share the playlist of those videos for you to go through it. I would recommend you to watch those videos before coming to discounted payback method. Okay. It discounts the future cash flows at an appropriate rate. Appropriate rate will be given in the question. The other names of appropriate rate are rate of interest or the discount rate. Okay, either way they'll give in the question as rate of interest or discount rate. It calculates the time it takes for the cumulative present value of cash inflows to equal the present value of cash outflows. The same thing which we did in the previous example, right? We added all the cash inflows, that is called as cumulative cash inflows, to equal to the present value of cash outflows. This is nothing but the initial investment. This provides a more accurate assessment of the investment's profitability compared to the traditional payback period. Here the calculation or the answer we get will be more accurate. Why? That I will explain to you now. See, the value of rupees today which you have now will be more than the value of the same rupee at the end of the year, right? Rupee always depreciates. With the same amount of money which you are going to buy today, suppose you have 1000 rupees with you, what are all the things you are going to buy today? Those things you cannot buy at the end of the year or 1 year after now. Rupee always depreciates. That's what I told you also. Okay, so when we consider the depreciating factor, that is the discounting factor, that is called the discounting factor, then the answer will be more accurate for you. That is why we say discounted payback method is more accurate than the traditional payback method. We are going to solve a question on discounted payback period. Okay, the question is as follows. The company is considering investment of rupees 1 lakh in a project. This considering investment means that is your initial investment. The following are the income forecast after depreciation and tax. Income forecast is cash inflows. Always you have to take cash inflows after depreciation tax only. This we have seen in the previous videos of payback period also. Okay. Always you have to take income cash inflows after depreciation and tax. Keep this in your mind. Okay. The cash inflows are as follows. First year 10,000, second year 40,000, third year 60,000, fourth year 20,000 and fifth year it is nil. These are all future cash inflows. Okay. From the above information, you are required to calculate payback period. That is, in the traditional way, we are going to calculate and discounted payback period at 10% interest factor. We are going to discount this future cash flows of 10,000, 40,000, 60,000, 20,000 at a 10% interest factor. That is the discount factor or the appropriate rate of interest. Okay. First, we are going to calculate payback period, that is a traditional payback period. For that, we have to prepare a table. In that table, we have three columns: year, annual cash inflow, cumulative cash inflow. First year, annual cash inflow is how much? 10,000 rupees. 10,000 rupees. So take it as 10,000 rupees. Second year, annual cash inflow is how much? 40,000. So take 40,000. Now cumulative cash inflow is 10,000 plus 40,000, it is 50,000. Next, third year it is 60,000. Take 60,000. Next 50,000 plus 60,000 becomes our cumulative cash inflow for the third year, 1,10,000. Next fourth year it is 20,000. 1,10,000 plus 20,000 becomes 1,30,000. That's our cumulative cash inflow for fourth year. Fifth year it is nil. So take 1,30,000 directly. 1,30,000. Okay. This is the table which we did now. See here. So now we are going to proceed with the calculation of payback period. The table shows that the end of third year, the cumulative cash inflows exceeds the investment of rupees 1 lakh. So, it exceeds 1 lakh at the end of third year. Therefore, payback period lies between second year and third year. Somewhere in between it's going to lie. Okay. Thus, the payback period is as follows. Payback period is equal to 2 years. Here 2 years is the base year. It's called as base year. So, payback period is base year plus 1 lakh. What is 1 lakh? 1 lakh is your initial investment minus 50,000. What is 50,000? 50,000 is your base year cumulative cash inflow. What is the base year now? Base year is 2 years. Okay. The whole thing divided by 60,000. What is 60,000? 60,000 is the last year, next year. Base years next year. The year after base year. Okay. Cash inflow. So the formula is base year from where it starts. It's here in this question starts from the second year to third year, no? So base year plus initial investment minus base year cumulative cash inflow. Here second year cumulative cash flow, that is 50,000, and next year cash inflow. Next year means base year's next year, that is 60,000. When 1 lakh is deducted from 50,000, it becomes 50,000. Then 50,000 divided by 60,000. Okay. 2 years plus 50,000 divided by 60,000 is 2 years plus 0.833. It is 2.833 years is the payback period as per traditional method. We are going to find out next discounted payback period. Okay, that is what the second part of the question. So calculation of discounted payback period. We are opening a table which has 5 columns: year, annual cash inflow, discounting present value at 10%, present value of cash flows, and cumulative value of cash flows. So here is same. The same question we are solving. 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. And similarly, inflows are 10,000, 40,000, 60,000, 20,000 annual, 10,000, 40,000, 60,000, 20,000 annual. Next, we are going to find out discounting present value at 10%. Discounting present value means 10,000 is a future value, right? This 10,000 cash inflows which we have taken is a future value because we are going to receive it only at the end of the first year. Similarly, 40,000 we are going to receive at the end of second year, like that, so on. So, for that, we have to find out the present value of the future value. 10,000 is 1 year later. What will be now? Okay. So, for that, we have to look into the present value table. This is a present value table. Here, columns are interest: 1%, 2%, 3%, 4%, 5%. It goes on like this, and period is 1, 2, 3, 4, 5. Rows are periods. Okay. So we have to see discount rate factor of 10%. At the end of first year, it is 0.9091. We are going to take this to our table. From the table, we found out that discounting present value factor at 10% is 0.9091. Now we are going to multiply 2 into 3. 10,000 into 0.9091, it is 9,091. Cumulative value of cash flow, since it is first year, it will be the same, 9,091. What is this 10,000? This 10,000 is your future value and 9,091 is your present value. Can you see that present value is lesser than the future value? Suppose you are going to buy one phone, okay, with 9,091 rupees today. After 1 year, if you want to buy the same phone, you have to spend new phone, okay, you have to spend 10,000 rupees. If it is, the market is going to grow up by 10%, that is the discounting factor is 10%. Second year at 10% interest rate is 0.8264. We are going to substitute in the table now. So we are taking 0.8264 to the discounting present value factor at 10% column. Now multiply 2 into 3, we get 40,000 into 0.8264, it is 33,060. Now cumulative value of cash flow is 9091 plus 33,060 is 42,151. Similarly, for third year, we are going to find out the present value factor at 10%. Third year, at 10% discount rate, it is 0.7513. Substitute it in the table. So 0.7513 in the third column. Now multiply 60,000 into 0.7513, it is 45,078. Cumulative value of cash flow is 42,151 plus 45,078, it is 87,229. Now fourth year, we are going to find out the discount factor. Fourth year, 10% interest rate, it is 0.6830. We are taking this to the table. 0.6830 is what we found from the table as the discount factor. Multiply 20,000 into 0.6830, it is 13,660. Cumulative value of cash flows, it is 87,229 plus 13,660 is 1,0889. Now we are going to find out the fifth year discount factor. Fifth year discount factor is 0.6209. Substitute this in the table. Fifth year annual cash inflow is nil. Discounting present value factor at 10% is 0.6209, and since it is nil, present value of cash flow is also 0. Now cumulative cash flow remains the same. 1,0889 plus 0 is 1,0889. This is the table which we did now. So from on seeing the table we can see that 1 lakh lies between third year and fourth year, somewhere in between third year and fourth year. From the above table we can see that in the fourth year the cumulative cash inflows exceeds the initial investment of 1 lakh. So it is in between third year and fourth year. Now you have to take first base year. What is the base year? Base year is the third year. So 3 years plus initial investment is 1 lakh. See here, initial investment is 1 lakh minus cumulative cash flow of base year. What is the cumulative cash flow of base year? 87,229. That is what we have taken here. 87,229 divided by the whole thing divided by next year's, that is base year's next year's annual cash inflow. The base year is third year and the next year it is 13,000. Fourth year's cash inflow is 13,660 divided by 13,660. Okay, so 3 years plus 12,771 divided by 13,660 is 3 years plus 0.935 is 3.935 years is the discounted payback period. Using traditional payback period, we got payback period as 2.833 years without considering the time value of money. After considering the time value of money, discounted payback period is 3.935 years. So now the payback period has increased when we consider the time value of money. So discounted payback period method is the accurate way of finding out the payback period of our investment. If you would like to inquire about the online classes which I take or to get more worksheets, you can contact us at acc.wiseacademy@gmail.com.